Hello, everyone. My name is Matthew Frailey. I'm the founder of BreakpointTrades.com. We've been at it since 2003, providing advanced technical analysis, market commentary, trade ideas, and mechanical trading algorithms like our 21 SPY and ES mean reversion systems, our KISS trend following systems, which are very unique, nothing out there like it. And we've been doing this for individual traders and professional institutions. All right, let's get started. This is going to be a very comprehensive newsletter. This is the weekend technical analysis review, and it's Sunday, October 22nd, 2023. As you know, market has had a heck of a correction since that bounce attempt from early October to mid-October, and we're now, especially on the S&P and Qs, basically testing those lows. Anyway, got a lot to discuss. So let's go ahead and get started here. This is our back-end recorder for our standard web page newsletter. So let's start that. Hello, everyone. This is Matthew Frailey with BreakpointTrades.com. First off, I hope everyone's had a nice weekend so far. It's Sunday afternoon, 4:50 p.m. And this is the State of the Market Weekend Technical Analysis Review. Sunday, October 22nd, 2023. As you can see via the table of contents, the newsletter is divided into 7 major sections. The first part, I have the opening commentary and my soapbox, so we'll discuss things there. Then we'll go ahead and move on to the general indexes. We like to do a top-down approach where we look at the bigger time frames, monthly, weekly, all the way down to intraday time frames. And the S&P 500 and the Qs are our proxy. We're also going to look at some of the big name stocks. Let's face it, 7 to 10 of the stocks are what have led the market the whole year. It's been extremely narrow breadth, things like Microsoft, Meta, Google. So I want to take a look at those. Then we'll look at bonds and yields, interest rates. Let's be honest, we need to see a reprieve there for the market to have a hope of a bounce. You have mortgage rates now at 8% essentially, if you've looked at buying a home. And I'm sure none of you are refinancing unless you absolutely have to. We're looking at custom indicators, some of these systems that I've built, make some comments there. We're going to review quite a few market sectors, and we're going to follow up with the US dollar, commodities, precious metals, which has had a heck of a rally. Gold's rallied a good 150 or so points over the last 2.5 weeks. And I think there's a major low there. The stocks have rallied as well. But I do believe that area also could see a dip soon. But I'll be looking for that as a buying opportunity once again. Now, as far as the market, guys, if you've been with Breakpoint Trades, you know that last spring we made a prediction that the market would likely rally and hold up all throughout the rest of the spring, throughout the summer, and then finally top out in later July and then have a correction in the seasonality time frame of the year, August, September into early October. And you know what? That's exactly what's unfolded. So we did well with our analysis there. And so far since early October, market put in a nice bounce there. And however, that nice oversold bounce lasted until about the middle of October, where the S&P 500 started to stall at an open gap resistance just shy of the underside of the 50-day moving average. So it failed just around that logical area. We were looking for a higher low potentially, but instead it's retraced basically all the way. The S&P is basically right at those October lows. The Qs are getting close. And, again, do or die here for the bulls. The onus, as we've been always saying, is on the bulls. Last week the S&P lost 2.4%, NASDAQ 3.1%, IWM 2.2%. Gold was up 2.7%, unsurprisingly. The 10-year Treasury yield hit 5% last week, closing at 4.925%. Again, what has always bothered Steve and myself is that back in early October on that first low, the S&P 500 didn't test its 200-day moving average. As you know, it got really close, and then it bounced. We always had a problem with that. It was generally, again, call it superstition, call it years of observing charts in the markets. We've always noticed whenever price gets very close to one of those major technical levels, it often tags it and undercuts it. And it didn't, and that's bothered us. Well, on Friday, the S&P 500 closed back below its 200-day moving average, so our concern was obviously warranted. Okay. Also, in the last week's newsletter last weekend, Steve said the onus is on the Bulls. However, the Bulls could not intercept the football, using a football analogy, and they're now basically testing the October lows. Okay, so also last week, Steve illustrated these leading diagonal patterns, and we said unless the S&P could bounce from there or right here at a double bottom potentially, then we favor those leading diagonals for a fifth wave move lower. Another thing to concern, guys, is the Qs is still very far above its 200-day moving average, unlike the S&P, which is now below it. So the Qs may also need to play catch up and also get down to the 200-day moving average. If that occurs, then that'll obviously make those leading diagonals play out. The other potential, the more bearish view is that this is a nested 1-2-1-2, and we put in a major high of the bear market. Okay, kind of like I said in some of the comments here, the question remains, did the bear market end in 2022? Yes, we had a nice retracement rally this year, but it still was a lower high ultimately. Could that be a lower high of a wave B of a larger bear market rally? It's possible. There's enough fundamental factors, backdrops to support that. Crazy unsustainable debt levels, declining earnings for companies, coming recession, mortgage rates 8%, commercial real estate crash that's going to come, China imploding, again, still very rich valuation in the stock market. For example, the top seven valued tech stocks that have led this market have a PE of about 46. Obviously, a higher PE is justified for them, but that's pretty damn high. Also, guys, this week, earnings season, as you know, market hasn't really bounced in earnings season. This week, we got a ton. We got a lot of these big stocks, big cap tech stocks reporting that are such strong weightings on the market. Microsoft and Google on Tuesday, Meta on Wednesday, Amazon on Thursday, and then Apple's the following week, November 2nd. So let's see if the market's going to put in a bounce. Those need to react well. If they do not and they decide to sell off and play catch up, well, the market's going much lower. Geopolitical, obviously, that's a factor in the market and continues to be a wild card. Interest rates, bonds, US dollar. The hope for the market here is that bonds are maybe at some sort of trade low or near one, and rates could be at a trade high, but we'll see. And as far as mean reversion systems, unfortunately, we still have some of these that are still in a trade. As you know, a few of those trigger that trend condition hold, and obviously that doesn't look so good now. But in the future, what we're going to do, guys, since they are mean reversion systems at their heart, whenever they get the mean reversion bounce, we're going to sell half in the future. Yes, it's easy to say that right now, hindsight 2020, but I think that makes sense. Their mean reversion, if you get a mean reversion, take half off, and if a trend hold conditions, well, you can hold the other half for that trend. It just for safety. So we're going to do that in the future, and those systems are likely to stop out here any day. Okay, just letting you know. And the KISS trend following systems, one of my plans is to add a new high performance small basket that I've been showing you guys. Some of these we'll be charging a premium for it. Don't worry, it's not going to be crazy, but I don't think it's too much to ask, especially with how powerful some of those systems are and what we all do here. Anyway, guys, let's go ahead and get started. Enough of my soapbox. Let's get into the general market. So item number 2 shows the index sector table, what transpired on Friday, which is a strong down day. As you can see, index is down 1.5 to 1.3%. For the week, strong losses. S&P down 2.4%, NASDAQ down about 3%, Russell down 2.25%. Dow down the least, obviously. It's going to get its 30 stocks. We don't look at it that often. And again, pretty broad weakness here. You can see almost all the 21 sectors were down on Friday except transports. Most of them were down for the week except retail, surprisingly. And currencies, US dollar has been a little weaker here lately. That is something to watch that could help things, but we'll keep an eye on that. Crypto has had a big move. Big move last week. So Probably with some of the uncertainty there. Also, I think BlackRock is close to getting their ETF approved, so that'll probably produce a boost. Commodities here for the week, mostly to the upside. Coffee gained 6.68%. I don't have a chart on that tonight, but big move there. Don't tell Starbucks. They might raise your latte. Natural gas down 10.4%. So hopefully you guys took some profits on that. Nice pullback there. The index was up 1.13%. Again, some gains in the ag area. What really did well here and has been doing well is the precious metals. Gold up 2.7%, silver up 3%. GDX, the miners, up 1.8%. They are lagging a bit here. And again, I do think this area is a bit overdone in the short term, so I'm looking for a pullback there. I offered dust tonight as a trade idea for a pullback there. And as far as bonds, again, 10-year almost basically at a high of 5% last week, closed just shy off of it. We do have divergence on the daily chart, so we'll see if that can kick in or not. Next, item number 3 shows the economic news calendar. You can see what's all in the docket here this week. Obviously, GDP, any of this kind of stuff, PCE. And remember, earnings, we got a slew of earnings. A lot of those big cap tech stocks are reporting Tuesday, Wednesday, Thursday. Remember? So, all right, guys, let's go and jump to the index charts. So the first chart below, item number 4, is a monthly snapshot of the 5 major indexes with the simple Bollinger Bands. And you can see so far we have 3 months down. Again, remember, we are looking for a pullback correction this fall after July, and that has been unfolding. Right now, the Dow is near this kind of longer uptrend line for the 2020 low. S&P not quite there, but nice pull in here so far. Chart 5, here's a weekly view of the indexes, which again had a really nice healthy correction last week. S&P and NASDAQ basically testing their lower Bollinger Bands. The Russell at the bottom, well, what can I say? I mean, it finally busted below this pattern and is weak as hell. Next, chart 6, here's the daily snapshot of the major indexes. So again, as you know, we had that bounce attempt in early October, but stalled right in the middle of October, essentially at the August lows there, you can see. So we expected a pullback there, but now we've retraced on the S&P basically all the way. The only hope here, I'd say, for the bulls is like a double bottom, but boy, onus is on the bulls there. Otherwise, favor some sort of 5th wave move down. Short term, we could maybe see a little bounce, maybe a little 4th wave, but I'll talk about that below. You can see the other indexes below, lower Bollinger Bands. And the Russell at the bottom is below its lower Bollinger Bands. The Russell, guys, is more indicative of what the average stock this year has went through over the Qs and S&P, because it doesn't have those weighted stocks that skew everything. Guys, if you take out the 7 to 10 big cap stocks out of the market's down this year, okay? So I've never seen such a concentration before in my life, such narrow breadth. Next, let's move to the S&P 500 charts. So chart 7, here's the yearly chart. So the S&P is up 10% still this year. I haven't shown this chart for a while. Back in late 2020, I showed how far price was away from the 9 EMA, the 9-year EMA. Usually in bear markets, you test it or undercut it a bit, okay? We did not in 2022. We were so far away from it. Then we've rallied up this year. We're off the highs. If this is a larger bear market still, we have a lower high. This 9 EMA could still be a target over time. Next, chart 8. Here's a monthly view of the S&P going back to the late 2006. So, we had that 2008 correction there, early 2009 bear market bottom, secular bull market since that time. Heck of a rally, up 1,000% or so. Anyway, we've been showing this channel for a long time. We had a nice pullback from that channel in 2022. And we've had a good rally up. Pretty decent retracement, something like 84% retracement. But again, one option, could that still be a larger bear market? So for that, could that still be a larger wave B and we still come lower over time in a wave C? Perhaps down to one of these longer term trend lines, I drew a couple here. One connects the candle bodies, one connects the candle wicks. Okay. That's still definitely possible given the fundamental backdrop and everything else. We'll see. Anything goes, but it is still a possibility. You can't rule it out. Chart 9, here's another monthly chart, but this one goes back to 1973, and you have a larger trend line all the way back to 1974, connecting 82 low, connecting the 2008 low. Would take one hell of probably a depression to get us back down to there. That's down around 1900, as you can see. But again, just some things to consider longer term. Next, chart 10, here's a quarterly view of the S&P. I haven't shown this one for a while. Again, quarterly chart, so each candle represents 3 months. There's 4 candles in a year. Again, you can see how crazy far price got away outside the Bollinger Bands on a quarterly. It was due for a pullback, and that's what we've happened. So, again, question is, do we still rally to a new high, or do we have a larger, bear market move down still like that? Next, chart 11, here's a weekly view. So again, weekly, every technical is lined out just beautifully in late July. We rallied to the top of this channel, this resistance zone, happened to match with seasonality. We've expected a correction August, September, early October, and that's what has unfolded. We're now down here slightly below this channel line. Moving average ribbon is trying to go bearishly stacked a little bit. RSI broke its trend line there, so onus is on the bulls here, obviously. One thing to watch is the 50-week moving average there as well. Next, chart 12, here's a clean Rinko chart. Each candlestick is 30 points. Nice clean chart. You can see resistance levels, support levels. So we've come down to this potential support level. You can see it's been support a couple times and resistance. So this is an important level right here, a breakpoint essentially. Next, chart 13, here's a daily view of the S&P. Again, the one thing that bothered Steve and I in early October was we didn't test the 200-day moving average. We got close to it, and that always bothered us, and that bothered that uneasiness. That's the best word. Definitely proved out because it rallied up, stalled at this gap, didn't quite fill this cap, and then sold off, and we're back to the low now and slightly below the 200-day moving average. Now, could we bounce from here as a double bottom? Yes. Bulls would need to regain this broken trend line at minimum. Otherwise, down here, here's some levels below that could be targets over time, some open gaps and other things. Right now, anyway, let's move on. Chart 11 or 14, here's the SPY, kind of a zoomed in view. So a couple options here, guys. This is we're either favoring this move down a wave 5 for that leaning diagonal, or the most bearish view would be a nested 1-2-1-2. So like a 1-2-1-2, and this would be starting a 3. So we'll see, guys. Next, chart 15, here's the 2-hour view, shows that same thing. Again, we are into a little bit of a demand zone here, basically a double bottom. That lower trend line's not too far away. That could also be tagged pretty quickly. One option that would probably mess with the bears would be a quick flush to here and then recovery. Next, chart 16, here's the daily KISS trend system. Again, you can see how price stalled perfectly at that ATR, tagged it multiple times, couldn't get above it. The nice thing I like about the ATR is its average true range, and so it's self-adapting to how the market volatility is. The market gets more volatile, it gets wider. The market is less volatile, it gets tighter. And this one has a special weighting to it. It gives a little more weighting to the current bar. So it's kind of like an exponential ATR. But anyway, we stalled there. We're back slightly below the 200-day moving average. The KISS system, of course, is flat. Chart 17, here's the 4 time frames. Again, the daily, the upper left, we stalled right at the ATR just perfectly. On the half day, we had that said bearish rally resistance cycle, and that was correct. Price stopped right there. We lost the ATR on all those other lower time frames. Short term on the 78 minute, I will say the moving average ribbon is pretty wide here. We got it to mark 13, so I wouldn't be surprised if we had at least a fourth wave bounce here. Trevor 18, here's a 2 hour view. Again, we stalled at that open gap. Now, I guess one problem is we didn't fill that gap either, you know. So I still think that's a potential to fill that eventually. You usually fill gaps. We're down near this double bottom area. Trevor 19, here's a 60-minute view. So again, like I said, very short term, we're oversold. You can see we have some RSI divergence. Like I said, one option could be this is a wave 3 and we get a wave 4 bounce. But then after that, then we get another move down in a 5. Trevor 20, here's a 15-minute view. Again, you can see some MACD divergence, RSI divergence here. So I'm kind of wondering if if news don't have any crazy news over the weekend, overnight, we could have a bounce here for at least a fourth wave. Next, let's move on to the triple Qs. Chart 21, triple Qs daily. Again, stalling perfectly at that downtrend channel line 2 weeks ago into that supply zone. Just perfect. Again, we're near this low. Do we bounce here, or is that lower trend line of the channel or even the 200-day moving average a target now? Remember, the Qs or the S&P is now below its 200-day moving average. Does the Qs need to get there as well? If that does, that'll extend this correction, of course. Chart 22, there's another daily view of the Qs showing that leading diagonal Steve showed last week. That fifth wave move down, which appears to be playing out. Chart 23, here's the triple Qs KISS system. Again, it's been flat since it had that little whipsaw stop out in September. The KISS system has done well this year. It had 2 nice winning trades there earlier in the year, had a little whipsaw, and it's been flat ever since. Next, chart 24, here's the 4 time frames. So the daily up here in the upper left, price stalled perfectly at that resistance cycle there. And price is now right at the support cycle. It's either bounce here, do or die, basically. Obviously, the other time frames stalled at that resistance cycle there perfectly on the half day. 78 minute, just like the S&P, we have a DeMark 13, pretty wide MA ribbon. So oversold bounce could occur. Chart 25, here's a half day chart showing this kind of a channel type thing. We stalled at the top of that trend line. That lower trend line's here. Again, if we bust through there, remember you have the 200-day moving average on the daily below. You also have this open gap. It was never filled. Those gaps like to be filled. So that could be a target area too. This area right here around the 333 area. Chart 26, here's a 60-minute view of the Qs. Again, like I said, one option here with a little divergence. We're quite oversold. We could have a bounce here, but it may just be a fourth wave bounce and then we come down again. Next, chart 27. Here's a 15-minute chart. Again, you can see how price really accelerated down, kind of like started going parabolic late in the week by Friday. Next, let's talk about these big cap tech stocks, which have all the weighting effects in the market. So first off, here's Tesla. Tesla, we had it labeled as a coil pattern. The bearish labeling played out where wave E, lower high bounce there, and broke down. You had a chance to play that on earnings. And of course, after earnings, gap down, and it's playing out. Here's some potential measured moves. And really, this does measure lower. Down here, a little below 200, some other ones around 180, but that is playing out. Oh, on Tesla, you got to think, guys, most people finance cars, and with interest rates now on cars like 10% or whatever, that hurts Tesla. Anyway, AVGO, here's a Broadcom, still holding up very well. It tested its recent highs. It has pulled back pretty good. It's right near the 50, 20-day moving average. If it can bounce there, that's a positive. If some of these big cap tech names start letting loose, then the market's going to go much lower. Chart 30, here's Apple. Apple's been coming down as well. Now, it last time it also almost tagged its 200-day moving average, didn't quite, so it may want to undercut it too, just because it's close. Chart 31, here's Nvidia. We've been showing this pattern. The bearish view is we have a rounded top here, head and shoulder pattern. Okay, there's a neckline here, hasn't broken. But if this were to play out, here's my targets. At least the 200-day moving average below would be the first target. Then my next target would be filling this gap down here around 300. Market would not like that, but that's a short you could watch. Chart 32, Microsoft, still hanging in there pretty well. Now, if it starts losing these two major moving averages, that'll be something to take notice of. Chart 33, here's Amazon. This looks a little precarious, kind of looks like a bear flag forming there. Wouldn't be shocked if it broke down and tested the 200-day moving average. And finally, chart 34, Meta, is still holding up very well. It made a brief new high, testing now this little broken extended trend line. Again, keep an eye on these names, guys. Remember that quite a few of these are reporting this week. Again, on Tuesday, Microsoft, Google, Wednesday, Meta, Thursday, Amazon. Apple reports the following week. Let's move to the Russell. Chart 35, here's the Russell IWM, weekly down 2.25%. This bearish triangle obviously played out. We're now working on that wave C lower. And below here, here's another demand zone if things really break down. The first big support is this area at 160, which was previous resistance, became support a couple times in 2022. Chart 36, there's the daily view. Again, just crazy sell-off from the top of that pattern. Head and shoulder played out absolutely fantastically. Chart 37, there's that head and shoulder. Again, that was pretty clear pattern. Played out, obviously. And finally, chart 38, here's a 2-hour review. That little bounce last week stalled at the supply zone, took out the lows. All right, guys, that does it for the indexes. Again, onus is on the bulls. We'll see how futures open here over the weekend. I know futures, at least by the weekend betting futures, look like they may be up a little bit. Let's move on, look at bonds and interest rates. So chart 39, here's the 10-year Treasury yield. Again, up once again, up 6.3% for the week, hit 5% at the highs. After breaking out of resistance here, it has been up, up and away. There is a little RSI divergence here just to be aware of. What the market really needs is a reprieve in interest rates. Chart 40, here's the daily view. Again, I will say price was starting to go a little parabolic in nature here. You do have RSI divergence and a little MACD divergence. But again, that could still be blown out, but this is something to watch. A good pullback in rates would help the market. Chart 41, there's the big picture view going back to the early 80s. Remember, secular bear market and the 10-year Treasury yield ended with the break of this channel 35-year trend line. And prices rallied up now all the way into my next target right around this 5 to 5.25 range. This is a supply zone. We'll see if it stalls in here or not. Again, longer term, guys, rates are now in a secular bull market, but they're not going to go straight up. Eventually, they're going to have a healthy pullback, maybe something like an ABC pullback, right? And then they'll probably go up again. Okay, that would obviously help the market on that pullback. But again, the new normal is high rates, for the next 10, 20 years. Next, chart 42, here's TLT 20-year bonds. Again, they're opposite of rates. They made a new low last week. There is some MACD divergence here. I always like to see MACD divergence and RSI divergence. And you can see price was getting a little parabolic in nature, unsustainable in the long term. We'll see if this can bounce or not. Chart 43, here's high yield corporate with the S&P. Remember, the two move together. You could just see these two weekly charts. See how they move together. And high yield corporate has been leading down, and so the S&P's playing catch up. Chart 44, here's high yield corporate on the daily. Okay, this actually made a new low last week. And chart 45, here's the 60-minute version. This gave an early warning. So in mid-October, S&P made a little higher high. This made a lower high, and lo and behold, that gave a good warning. High yield corporate is that pulled the market down. All right, guys, let's move on. Look at some market indicators. Chart 46, here's the NASDAQ new highs, new lows summation as a cumulative chart. Again, this to me illustrates perfectly the crazy negative breadth in the market. I mean, guys, so this started giving us warnings back in late 2021. And then this crossed for a sell. It obviously went down in 2022. But look what happened in 2023. We had that really good rally from March into late July, but this declined. And obviously it's going down again. So this is the effect you get of 7 to 10 stocks that have held the entire market up. This is why you're seeing this, because this represents all the stocks, okay? So collectively into the surface, most of the stocks aren't doing well. Those 7 to 10 stocks with their huge weighting, Apple is something like 10% of the Qs, strongly affect the indexes. Chart 47, here's the VIX and the VVIX. They're above their upper Bollinger Bands 2 consecutive days. This is something to watch. Again, the VIX could rally here, if the fear spikes. But also a close back below the Bollinger Bands would be a buy signal. So it's something to watch for. Chart 48, there's the VIX itself. Again, you get your buy and sell signals when you get outside the bands and back inside. Chart 49, here's the put-call ratio. One thing that bothers me is the put-call ratio is at 1.04. So there's no fear here, guys. Look, back in early October, this had spiked up to 1.59. It's 1.04. There's no fear. That's concerning to me. Chart 50, here's the NYSI 9 EMA system. And last week I talked about this confirmation candle where whenever you get a cross, like a bearish cross, you need to take out the low of that candle to trigger, just like here. When you got a bullish cross, you need to take out the high of the candle to trigger. And that actually filtered at that little whipsaw. So system here is a pretty effective system. It's obviously still not long if you use that trigger. Chart 51, here's the NIMO and the NAMO. Those are the McClellan oscillators with their Bollinger Bands. They're not below the Bollinger Bands or anything. That's one trigger for a trade. One thing there is still positive here. We still have a higher low on the NIMO and NAMO versus the S&P. But again, that could be blown out on a further decline. And guys, let's go and jump to the market sectors. We'll look at a slew of these sectors. So the first one, chart 52, airlines, a subcomponent of transports. I mean, my God, look at this sell-off. Down something like 61, 62 consecutive closes below the 9 EMA. Divergence building. Eventually this is going to bounce, but holy cow. Be careful catching a falling knife. Chart 53, here's Jets, the airlines ETF, and just amazingly how tight of a downtrend channel this has remained in. Chart 54, here's technology XOK again, essentially mirrors the Qs. So the question is remember this is highly affected by those 7 to 10 stocks. Does this want to play catch up and get down to the 200-day moving average? Chart 55, here's XLC. This has a lot of those big cap FANG type stocks, and you can see it's hardly pulled back again because it contains things like those Microsofts and everything else. So if some of these sectors that have held up so well start letting loose, that would give the market reason to sell off a lot more. Chart 56, here's semiconductors. Nice weakening from this area. Near its 200-day moving average now. I think it at least needs to tag it now, undercut it maybe. Chart 57, financials. Again, this area has been pummeled. We all know what's coming, especially with a lot of these banks. But down here, there's an open gap to fill. That could be the next magnet. Chart 58, banks. Banks are horrid. Look at this decline. Back near the May lows. And again, all the bad loans there, commercial real estate, interest rates. I mean, it's crazy, guys. Jarbor 59, healthcare, still, it's moving down, still in this bigger coil pattern. Jarbor 60, XLC on the weekly. I meant to, this one got out of order. I meant to have it up with XLC daily. One thing to note, it got near its 61.8 fib. It's so far, that's where it's logically been failing. Jarbor 61, IYT transports. You know, we've been showing this as a bearish pattern. We showed it as a bearish pattern back in August, broke down. Also now breaking a recent support here as well. Jarbor 62, materials. Boy, this is really weakening. Testing this lower trend line here, but down here is a demand zone, which could melt down into, obviously. Jarbor 63, biotech. Man, hell of a correction in this area. Again, guys, I'm just showing you some of the carnage that has occurred under the surface with these sectors. Jarbor 64, real estate, IYR. It's basically back to the 2022 lows. Are you surprised with where interest rates are? No. Jarbor 65, IYR in the daily. Lower high, obviously, in October. Back down to the lows. Moving on to commodities. Jarbor 66, DBC. Again, nice recovery off that 200-day moving average. Still have a lower high in place so far. Jarbor 67, here's DBC. Again, commodity index on the monthly time frame. To me, it's in a bull market, and this has simply been an ABC correction in an ongoing bull market. That could be a wave 2, and perhaps this could now be going up in a wave 3. I like this longer term. Jarbor 68, crude oil. Again, as you know, this has been bouncing in the Middle East situation, but to me, this does look like it's forming some sort of bear flag. You can see how price has been stalling right around that 61.8 fib area, which is what you'd expect. Jarbor 69, copper, still holding on to this shelf support, and that's basically what it is. If it loses that, it could let loose to the downside. Recession would likely hammer this lower. Jarbor 70, DBA, bounce up off the pattern, essentially in the middle of it. Jarbor 71, here's the 60-minute view. Remember I talked about this bullish symmetry break back in early October? That led to the higher low. It was an easy buy. Nice move. Jarbor 72, uranium. So far this has been playing out. Back here in September I said it was overbought. It's had a pullback. I said I wasn't buying that first pullback. I considered it a wave A. It bounced up, lower high. So far it's struggling here. It's forming a coil. So it's either going to form a zigzag, which would wave C would be below A, or it's going to form a sideways coil, guys. Okay, but it's getting more interesting since it's now had more consolidation time. Jarbor 73, there's the monthly big picture view. Again, just like on DBA, consider this in a bull market, which started in 2020, late 2020. They had the first leg up of the bull market, the consolidation of the bull market, and then we broke out of this coil. And again, I think this thing eventually goes up into the 30s and 40s. Jarbor 74, here's Bitcoin. Nice rally last week. Steve kind of has a little head and shoulder illustration here, whether that plays or not, who knows. But it did rally nicely last week. Jarbor 75, Coinbase. Still monitoring this one in a tight coil here. Moving on, Jarbor 76, US dollar. Down 0.4% last week. Again, we have some doji topping candles here, so we'll see if this leads to more of a pullback or not. Jarbor 77, here's the daily. Right now we have a tiny small coil here forming. Let's see which way it breaks. Moving on to precious metals, Jarbor 78, gold. Again, gold, good, rallied up a good 180 points off the lows, 190 points, 200 points if you count the high. Closed off the highs last week. We broke through the downtrend line. I favor that a major low ABC is put in. Again, if you're not long this, I think, or at least if I wasn't long, what would I be doing? Remember, I can't legally advise you. I would probably look to buy a pullback, and I like to see a pullback hold this broken trend line. Short term, the stocks are outperforming, the metals leading, and you generally want to see the stocks lead. Jarbor 78, there's the weekly view. Again, my view is we had a 3-wave ABC pullback, and this is eventually going to take out this 2100 resistance area. in a big way. Charter 80, there's gold on the monthly. This is the super bullish view where gold could be theoretically starting a wave 3. Wave 3 would likely take this up into the mid 2000s. Then you get a pull back, and then a 5. Maybe gold could end up there around $3,000 if this were to play out. Charter 81, here's silver. Nice rally off that lower trend line. Charter 82, silver on the bigger picture view. You can see this bigger coil-like pattern setting up. Moving on to the mining stocks, GDX. So nice rally in GDX from that October low. So far, struggling at this supply zone, logically. We broke the downtrend channel line, which is now a support area and an area to watch. Charter 84, GDX on the daily. Again, you can see the same channel. The channel trend line to me would now be support. Keep an eye on that ratio, of course. Charter 85, GDX on the 60-minute time frame. So a few weeks back, I showed this falling wedge 5-wave pattern with MACD divergence. Whenever you see 5 waves, guys, expect a decent counter trend move, and that's exactly what happened. Now, price has been stalling at the supply zone. Stocks are underperforming here relative to the metal. So I favor some sort of pullback here. Charter 86, here's the BPGDM. Again, it was an overbought territory where it gave the sell signal in early May, and it got to the oversold territory, and it's bounced and gave that buy signal from. Another view, Charter 87, here's a non-Renko look. You got a little resistance right around the 1780 area. A breakthrough there would be a positive as well. Guys, one of the custom KISS systems I'm going to be bringing to the website is perhaps the 60-minute GDX KISS system. 78-minute might sound like an odd time frame. There's 5 bars in the daily cash candle. So anyway, this went long back here, early October, excellent entry. If you're wanting a tight stop idea, 28.90 is the stop. Charter 89, here's the statistics for that GDX KISS system versus buy and hold. And it's not even a question. I mean, look at these gains to buy and hold, almost 5 to 1 this made versus buy and hold. But the real effect is the lack of drawdowns, average of 5% drawdown versus 35 to 25% for buy and hold. Not even a comparison. I plan to add a basket of these custom KISS systems to the KISS section in the next several weeks. Moving on, chart 90, here's Dust. That's the inverse ETF. If you own some of these precious metal stocks but you don't want to sell them, this could be a way to hedge it. You could trigger off this doji with a stop. Chart 91, here's Dust on the 60-minute view. You can see the MACD divergence that's set up here that could favor a bounce. Now let's look at a few individual names, the final part of the newsletter. So here's GOLD, Barrick. I gave this as a long idea back in early October off this doji. Your trigger was the high of the doji, 1425, with an immediate stop right at the low, 1381. Look how well this has played out. Pulling back a little off the 200-day moving average. Chart 93, DRD is another one I've been listed, broke through the channel. Broken channel line is now support. Chart 94, here's the OR, another gold stock, broke through the channel, testing its 50-day moving average. Here's some other names to monitor. HL, Hecla Mining, it's a silver stock. One potential pattern that could form is a high or low right shoulder. Chart 96, AG, Majestic Silver. This is a weekly chart. Again, guys, look at this thing. It was 23, 24 bucks back there in 2021. It's now in the 5s. Not a good buy and hold, is it? Or has it been? Here you got a wedge. It could be a lower risk entry if the precious metals start entering a bull market trend. Chart 97, AGI, another one. This one pulled back, found support here. Made sense. Got a resistance right here at 13. And the final chart, chart 98, MTA, another precious metal stock. I'm just showing in here, it's all the way back to this area. This was previous support, previous resistance. You can see the pickup in volume, like a capitulation volume. This could be a lower risk entry. I mean, it was 13 and a half bucks back in 2021. It's now 283. So one hell of a haircut. It is near a support if someone felt like dipping their toe in and taking a shot. All right, guys, let's see where old futures open at tonight. Again, everyone on YouTube and Breakpoint Trades, I appreciate your support. And if you can, recommend us to some family, friends. We really don't have an advertising scheme, so we really rely on a lot of you guys' word of mouth. Again, thanks for all your support. Have a good rest of your Sunday. Take care.